Grant sends every extra dollar to the bank. Every bonus. Every tax refund. Every spare $100 that survives the grocery bill. His mortgage balance falls faster every month, and he watches the numbers shrink with the kind of satisfaction people usually reserve for weight loss or sobriety. Meanwhile, Vanessa does the opposite. She makes the minimum mortgage payment possible. 30-year fixed. No extra principal. Every extra dollar goes into index funds, treasury ETFs, and a growing brokerage account she checks almost obsessively. Grant thinks Vanessa is reckless. Vanessa thinks Grant is trapping himself inside an illusion of safety, and in 2026, both of them have evidence. That's what makes this conversation dangerous. Because the old internet advice was simple. Pay off debt before investing. Then another wave of internet advice arrived. Always invest instead. The market returns more. But somewhere between near-zero interest rates, post-pandemic inflation, asset inflation, layoffs in white-collar industries, and mortgage rates jumping above 6%, the math quietly changed. And most financial advice never updated. My name is Theo, and I spend way too much time thinking about why modern financial advice often sounds like it's still living in a completely different economy. If you're someone trying to decide whether your extra money should go toward investing, paying off debt, building cash reserves, or simply surviving the cost of modern life, hit like and subscribe if this video helps you, because this conversation is no longer just about returns. It's about liquidity, psychology, optionality, and what happens to people financially when the economy becomes unstable for longer than expected. A decade ago, the answer felt easier. Mortgage rates were incredibly low. Money was cheap. Refinancing was easy. Asset prices were climbing almost nonstop. If someone locked in a mortgage at 2.7% in 2021, the math heavily favored investing instead of paying down the house early. Why? Because the spread between borrowing costs and expected market returns was enormous. Borrowing at under 3%, while the S&P 500 historically returned much higher, created an obvious mathematical argument. And that era shaped almost all modern financial content online. But by 2026, average mortgage rates are sitting around the mid-6% range depending on loan type and borrower profile. That changes behavior. Not just spreadsheets, behavior. Because 6.5% debt does not feel psychologically identical to 2.7% debt. Not even close. Grant understands this emotionally. He works as a logistics manager outside Phoenix. 46 years old. 2 kids. One income became 2 incomes and then became 1 again after his wife lost her HR position during a restructuring cycle in late 2025. Now every monthly expense feels heavier than it did 3 years earlier. His mortgage payment doesn't just feel like debt anymore. It feels like vulnerability. And that emotional shift matters more than most financial discussions admit. Because personal finance is rarely about maximizing mathematical efficiency. It's usually about reducing fear. That's the hidden layer most investment debates ignore. People don't aggressively pay down mortgages because they calculated the perfect net present value equation on a Saturday afternoon. They do it because debt creates background anxiety. Especially after 2022. Especially after layoffs spread through industries that once looked untouchable. Especially after inflation changed what middle-class stability feels like. The strange thing is that Grant's strategy actually becomes more rational during periods of economic instability. Not mathematically superior, psychologically superior, and those are not the same thing. Because something subtle happened after the low-rate era ended. Volatility stopped feeling temporary. That changes how humans value certainty. Suddenly, owning more of your house doesn't just represent financial progress. It represents reduced exposure to a system people trust less than they used to. And yet, Vanessa isn't wrong either. That's where the story becomes uncomfortable. Because Vanessa understands a different hidden layer. Liquidity. She's 38, works remotely in cybersecurity from Minneapolis. No kids, high income, large emergency fund. And she keeps saying something Grant hates hearing. You can't eat home equity. At first, that sounds ridiculous. Until you actually watch what happens during financial stress. Because home equity is a strange kind of wealth. Technically valuable, emotionally comforting, but often financially trapped, especially in bad economic environments. That's the part older financial advice rarely prepared people for. During stable decades, home equity felt accessible because refinancing was easy. But when rates rise, liquidity changes completely. A person sitting on massive home equity with a 2% mortgage once had flexibility. A person sitting on massive home equity with a 6.5% refinance environment suddenly has a locked asset. And locked assets behave differently during emergencies. This becomes painfully obvious during job loss. Imagine Grant loses his job for 8 months during a recession. On paper, he looks safer because he aggressively paid down principal. But most of his extra cash no longer exists as liquid money. It's embedded inside drywall, flooring, roofing, and the local housing market. Which means his financial safety now depends on whether banks are willing to lend against that equity during an unstable economy. That's a very different kind of risk. Meanwhile, Vanessa's investment account falls during a market downturn. Her portfolio drops 20%. Emotionally, it feels horrible. But she still has accessible liquidity. She can pause investing, adjust spending, sell selectively, survive without negotiating with a lender. And survival changes financial outcomes more than optimization does. That's another hidden layer people miss. Most long-term wealth destruction doesn't happen because someone earned 1% less annually. It happens because people lose flexibility during crises. Forced selling, high-interest borrowing, panic refinancing, liquidating retirement accounts, missing mortgage payments, career desperation. Financial collapse usually arrives through cash flow pressure, not spreadsheet inefficiency. That's why the mortgage versus investing debate became more complicated after 2022, because higher rates changed the value of liquidity. At the same time, inflation changed the value of cash. And rising uncertainty changed the value of emotional stability. Now suddenly all three strategies compete with each other. Aggressive investing, aggressive debt payoff, aggressive cash accumulation. Three different forms of protection against three different fears. That's why modern financial advice feels contradictory. Different people are optimizing for different survival mechanisms. And the economy itself keeps changing which fear matters most. For a while, the internet mocked people who paid off low-interest mortgages early, financially irrational, emotionally driven, bad math. But then layoffs accelerated. Housing costs exploded, insurance costs rose, medical costs climbed. Economic uncertainty stayed elevated longer than expected. And suddenly emotional stability became economically relevant again. A paid-off house dramatically lowers required monthly cash flow. That matters during recessions, especially prolonged ones. The lower your mandatory monthly expenses, the less fragile your life becomes. Grant understands this instinctively. He doesn't care about maximizing returns anymore. He cares about reducing the number of things that can destroy him. That's a fundamentally different financial philosophy. But Vanessa sees another hidden problem: opportunity cost. Because while Grant spent years aggressively eliminating debt, asset prices kept climbing. His home equity increased, yes. But his liquid net worth lagged behind. Meanwhile, Vanessa's portfolio compounded through market recovery cycles, dividend reinvestment, and employer stock contributions. By 2026, her invested assets substantially exceed Grant's, and this creates one of the strangest psychological contradictions in modern finance. The person who feels safer is not always financially stronger, and the person who appears wealthier is not always economically safer. That contradiction defines the modern middle class, especially in America. Because Americans increasingly live inside balance sheets that look successful but feel fragile. Net worth rising, liquidity shrinking, expenses inflating, stress increasing. The system rewards asset ownership while simultaneously punishing instability, which creates bizarre behavior. People become obsessed with owning appreciating assets while quietly losing the ability to survive interruptions in income. That's why this conversation is not really about mortgages. It's about optionality. Optionality is one of the most important financial concepts almost nobody discusses emotionally. It's the ability to change direction without financial collapse, to quit a toxic job, move cities, survive layoffs, handle emergencies, take risks, delay panic decisions. Liquidity creates optionality. Low fixed expenses create optionality. A strong investment portfolio creates optionality. And sometimes those goals conflict with each other. That's why there is no universal answer anymore. The era determines the strategy. During ultra-low rate environments, leverage looked intelligent. During inflationary uncertainty, debt reduction feels safer. During unstable labor markets, liquidity becomes king. The problem is that most internet advice still talks as if one rule works permanently across all eras. It doesn't. Financial advice is often just economic history disguised as universal truth. And 2026 is exposing that very aggressively. Mortgage rates remain far above pandemic-era lows, even after some recent stabilization. Housing affordability remains strained. Insurance costs continue rising in many states. Layoff anxiety still shapes household behavior. And many people are psychologically exhausted from prolonged economic unpredictability. That changes how humans value money. For some people, paying off a 6.5% mortgage becomes equivalent to earning a guaranteed 6.5% return psychologically. Not mathematically identical, psychologically identical. And psychology influences behavior more than finance textbooks admit. Because the best financial strategy is useless if fear causes someone to abandon it during stress. That's another hidden cost of maximizing. The mathematically optimal strategy often assumes emotionally perfect humans. But humans are not emotionally stable spreadsheets. People panic, people lose jobs, people get divorced. People get sick, people make irrational decisions under pressure. Which means resilient financial systems often outperform optimized financial systems over long periods. That distinction matters enormously, especially now. So what eventually happens to Grant and Vanessa? Interestingly, neither becomes completely right. Grant eventually reaches a point where his mortgage balance becomes small enough that the emotional relief starts delivering diminishing returns. At that stage, aggressively overpaying the mortgage no longer changes his stress levels meaningfully. So he slowly redirects excess cash toward investments and liquidity. Not because investing suddenly became mathematically superior. Because his psychological needs changed. Meanwhile, Vanessa experiences something else. A market downturn combined with industry instability. Her portfolio survives, her strategy survives. But emotionally, she discovers that watching large liquid assets fluctuate creates a different kind of stress than fixed debt. Not worse, different. And eventually she starts making modest additional mortgage payments herself. Again, not because spreadsheets changed, because emotional priorities changed. That's the uncomfortable conclusion nobody likes. Most financial strategies eventually become psychological strategies, not optimization strategies. And modern economies force people to constantly rebalance between growth, flexibility, and emotional survival. So when someone online confidently tells you there is one correct answer to the mortgage versus investing debate, look carefully at the era their advice was born in. Because advice created during zero-interest rate environments behaves differently in high-rate environments. Advice created during stable labor markets behaves differently during layoff cycles. Advice created during cheap housing eras behaves differently during affordability crises. The rules didn't exactly disappear, but they mutated, quietly. And most people never noticed. That's why the real question in 2026 is not simply, which strategy earns more money? The real question is, what type of financial fragility are you most exposed to? Cash flow fragility? Debt fragility? Liquidity fragility? Emotional fragility? Employment fragility? Because the answer changes the strategy completely. And maybe that's the strangest part of modern personal finance. The older the economy becomes, the less this conversation feels like math, and the more it feels like survival design. Because in the end, most people are no longer trying to build the perfect financial life. They're trying to build a life that can survive the next economic rewrite.